More than 10 years ago, the world began to experience something they did not expect to happen. Lehman Brothers, one of the most important banks in the United States, was failing, and it was not the only one of them. The panic for these moments spread through the international markets while worldwide, the economy was about to collapse. It was 2008 when the Great Recession occurred, but let's go to the origin of everything to know how we got to this point and if it is possible that it could happen again. In 1929, the United States suffered a great economic crisis, popularly known as the Great Depression, after which the U.S. government had to implement laws, such as the Financial Regulation Act of 1933. This is where the problems began, not in 1933, but in 1999, when this law regulating the financial sector was eliminated, in order to grow and consolidate the economy. Around the same time, the so-called dot-com bubble burst. The rapid growth and expansion of the web brought with it a great speculation, which caused many of these companies to go bankrupt. On September 11, 2001, something even worse happened. The attack on the Twin Towers created great tension and fear. These feelings caused the retention of capital, as fear makes investors seek to have liquidity by reducing their expenses. To create the opposite effect in the economy, the U.S. Federal Reserve began to reduce interest rates more and more, to the point that in 2004 the rates were already at 1%. This allowed people and companies to borrow money cheaply, encouraging consumption and thus reactivating the economy. Up to this point there were no problems, but this is where they start. While the rates went down, the bank credits increased drastically, but we would have to stop specifically in a type of credit, the mortgage credits. With the low interest rates, more and more families obtained these credits, and at the same speed more houses were built. But where was the problem? These mortgages given by the commercial banks were granted without rhyme or reason, that is to say, to anyone. Normally, before granting these mortgages, the banks carry out a study to find out if the applicant has sufficient economic solvency to be able to pay them in the long term, and this process is what the banks were ignoring. This was not only happening in the United States, but in countries like Spain. They even had their own real estate bubble. As economies were booming, no one saw the possibility of any country going bankrupt. The United States was growing, Europe was growing, China was growing. More and more people were buying houses, house prices were rising, real estate companies were making a lot of money, making more money they paid more salaries, people had more money and kept increasing the amount of these home buyers, creating a cycle that later imploded in this crisis. Mortgages were the boom, and the investment banks wanted in on it. They negotiated with the banks to buy their mortgages in packages that bundled many of them together and sold them as a single security. Here came into play the rating companies that study the different assets to give them a rating by which investors would be guided. These insurers gave the highest ratings to these packages, where the commercial banks camouflaged all the bad quality mortgages, given to clients without economic solvency, among a few quality mortgages so that they would qualify them as good assets. These packages were known as MBS, or mortgage-backed security. And the bad mortgages, as subprime mortgages. In this way, the debts that people had with the commercial banks, passed to the investment banks. Even these same banks sold them among themselves. These mortgages were sold as if they were very good to banks, funds, governments, and domestic and foreign investors, expanding the problem. Prices continued to rise and so did housing construction. A housing bubble was looming, which both the U.S. government and the Federal Reserve flatly denied. Inflation in the U.S. began to rise due to excess consumption, so starting in 2004 the Federal Reserve began to raise interest rates. Monthly payments began to rise, since these subprime mortgages were variable rate. Little by little more and more people stopped paying their mortgages, forcing the banks to start repossessing homes. This situation worsened, making the price of houses start to fall. The banks started to lose money, they could not do anything with the repossessed properties if nobody wanted to buy them, and the banks were already running out of liquidity. Let's sum it all up. We had a real estate bubble that was already starting to be quite noticeable. We have a lot of investment banks that have been cheated by other banks and by insurers, and we have a lot of subprime mortgages at risk of bankruptcy, not a favorable situation at all. The insurance known as CDS, credit default swaps, became very popular, and the companies that were beginning to realize the problem of the mortgage packages hired them in droves, but what the investment banks did not know is that these insurance companies did not have enough backing to deal with the situation that was brewing. In 2007, when this situation was already too big, the real estate bubble burst. At that time we are talking about more than 1 million mortgages in the United States alone. While capital was injected into public spending to rescue the financial system, some talked about what was happening as if it was just a scare, until by this time on September 18, 2008, Lehman Brothers, the fourth largest investment bank in the United States, declared total bankruptcy, which no one would have ever imagined. How that could happen. At that time nobody trusted the system. In this scenario fear acted as an aggravator of the problem, thousands of people were left in the street, many investors everywhere lost all their money, while only a few speculators who foresaw the crash got rich with it. Investment banks that could not be rescued by other companies died, stock markets were completely collapsed, other economies such as the European ones were also dragged into this crisis, as the United States was one of their main trading partners. Structural problems in the financial systems of some countries, such as those of Southern Europe, Greece, Italy, Portugal and Spain, began to be uncovered all over the world. These countries practically had to be rescued with the help of the European Union and the International Monetary Fund. Measures were imposed such as reducing public spending, increasing taxes, labor reforms, and absolute priority was given to public debt payments, all in order to reduce the deficit and restore confidence in the financial markets. It was not until 2010 that the U.S. markets began to stabilize. That of the affected European countries even until 2012 they were falling, but the economy did not fully recover until 2015. If you liked the video, don't forget to subscribe and leave us a like.